So just briefly to try and explain a bit about the carbon tracker analysis, because it is a really important and interesting contribution to this space. As some of you might know, basically their thesis is that the valuations on the stock market of major oil companies are largely based on their reserves, so the amount of available fossil fuels that they have to burn in the future. But if we're to meet our climate change targets of keeping climate change to below 2 degrees, then those reserves can't be burned. They are unburnable carbon. So if we do at some point acquire the political will to tackle climate change, the valuations of those stocks will, at a greater or lesser speed, plummet, with devastating consequences for the pension savers who are heavily exposed to those companies. And they are very heavily exposed, partly because the indices, the FTSE 100 and the indices against which pension funds measure their performance and which a lot of pension funds track, are very heavily overexposed to fossil fuel intensive industries. So the argument often comes back to this, that well, the risk of action on climate change is actually pretty minuscule. There's no real evidence that there's any political will to tackle climate change at the moment. To which I think the response is that the alternative does not exactly look great for pension savers either, because the alternative is catastrophic climate change, which may or may not be great for BP and Shell, but certainly isn't great for pension funds, who are what's called universal owners. They have holdings across the economy. So even if BP is doing great in a 6-degree world, your portfolio is probably not going to be doing great, because that has devastating implications for other sectors of the economy. And oil companies are very much in denial about this. I think, interestingly, we did some work, which I think Catherine mentioned in the last session a few years ago with BP. And as part of this, we were looking with Greenpeace at BP's annual report, which contained a highly reassuring graph for investors about the extent to which oil demand was projected to rise over the coming decades, which was based on projections by the International Energy Agency, clearly a highly reputable body. What BP failed to mention in its annual report was that the scenario on which it was basing those projections was what's called the IEA's reference scenario, which is a baseline scenario that assumes no government action on climate change and a consequent catastrophic 6-degree temperature rise. So essentially, BP's business model was betting on the end of the world. We drew this to the attention of various investors, and quite distressingly, most of them were not really interested. Some were highly shocked and started asking BP questions about why they thought that this was acceptable, but most showed very little interest. So what should investors be doing about this? There's obviously a momentum building, particularly in the US, and kind of coming over here around fossil fuel divestment campaigns. And that's kind of one response, that pension funds should just pull their money out of fossil fuels. I think there are certain practical issues around that, partly because fossil fuels are so overrepresented in all of the indices that pension funds track. It's a very difficult case to win. I think certainly you can be making arguments about pension funds pulling out of the most destructive forms of fossil fuel activity or going underweight in fossil fuels. I think there's a lot more debate that needs to be had, and that we're kind of trying to have over the next few months as part of our climate campaign about what that should look like, and what investors should be doing. But leaving that aside, even if pension funds don't change their holdings at all, they are still invested in BP and Shell. I think the real question is then, what conversations are they having with BP and Shell about their business models? Are they engaging with them to try and encourage them to move away from the most destructive forms of exploration and extraction, from tar sands and Arctic drilling, and towards renewables? Or are they actually, when they go in to meet BP and Shell, asking the first question that they ask is about their reserve replacement ratios? Because I think the issue here is, it's, as Catherine said, with banks, with RBS, it's not just a case of investors were not engaging with banks to encourage them to be safer. Investors were at the forefront of encouraging banks to be riskier, because their incentive was to maximize the bank's short-term profits. And it's exactly the same with climate change. I think not only are investors not having the right conversations with oil companies about climate change, at the moment they're actually having the wrong conversations. They're asking the questions about what are your reserve replacement ratios, because that's what will determine the stock price in the next quarter, and that's what will determine the remuneration of the intermediaries that Paul talked about in the chain who are managing our savings, even though we might not be retiring for another 30 or 40 years. So yeah, that's pretty much what I wanted to say, I guess. I think There are a bunch of other reasons why it's difficult for investors to act on climate change, including major collective action problems. This is basically a tragedy of the commons. It's difficult, genuinely difficult, for a single pension fund to take a lead on an issue like climate change that might have short-term negative financial consequences for that fund, even if it's positive for the system as a whole and therefore for pension savers as a whole. So we need to be thinking about how we can encourage forms of collective action. And I think we also need to be taking back control over the system and kind of rehumanizing investment. It is our money. And as Raj said, we can't necessarily move our money somewhere else, but partly in recognition of the fact that we can't move our money somewhere else, these people do have fiduciary duties to act in our interests, and we need to be asserting what we think those interests are rather more aggressively, I think, because the system is so dysfunctional and is so kind of riven with these dysfunctional incentives. I think the mindset of a lot of intermediaries in the chain is that their duty is to maximize performance against a benchmark. It's a duty to implement a model. It's dehumanized. I don't think there's a sense that their duty is to real people at the bottom of the chain whose money they're investing, and it's up to us to put that sense back into the system. Thanks.